But those who bet on lower inflation and interest rates long term were the winners. And it's always the data are very volatile, especially when you have the warmest winter in history here in the Northeast. So I think that's distorted the numbers quite significantly. And the interesting thing about seasonal factors, if that is the distortion, they all have to work out to 1 over the full year. So if they bumped the numbers disproportionately in January, it'll come out of other.
During a recent discussion, Cathie Wood, the CEO and founder of ARK Investment Management, shared her views on several topics, including the Federal Reserve, the markets, the electric vehicle industry, and other related areas. Cathie stated that the bond market suggests the Federal Reserve is nearing the end of its tightening efforts and that inflation is likely to be lower than expected. This implies that the inflation and interest rate concerns of the past 2 years were primarily due to significant supply shocks to the system. Cathie Wood has expressed the opinion that investors are mistaken in their concerns over high inflation and increasing rates. Wood believes that deflation is the more significant issue, as prices are consistently decreasing. According to Woods, there is no need to be apprehensive about inflation and increased rates, as evidenced by the consistent decrease in inflation since its peak in 2022, when prices rose at their fastest rate in 41 years. Prior to beginning the video, remember to subscribe to our channel and click on the notification bell for more informative content.
You know from last year, the bond market at one point had never performed as you had to go back to the 1700s. So long duration assets were creamed, including our innovation strategies. And it was all because of fears of inflation and higher interest rates. We do think inflation's coming down now. It always seems like it could come down faster, but we do believe it's on its way down. You listen to corporations out there, even those who have had pricing power, the staples, P&G, they get their pricing, but they lose the volume, 6% declines in volume for a staple company. So we do think the consumer is railing against inflation, and the Fed certainly is doing its part, and money supply growth is down. Our estimate is roughly 3% on a year-over-year basis. We haven't seen a decline in money supply since the Great Depression in the 1920s.
Wood commented that the market has experienced a significant inflation and interest rate scare, which severely impacted long-term assets over the past year. Wood noted various indicators pointing towards reduced inflation, indicating that the Federal Reserve should pivot soon. She stated that the market is anticipating a signal from the Fed, which she believes will arrive in the first half of 2023. She added that the firm believes inflation will come down to the 2% Fed target level. However, Wood predicted that inflation could fall below this level and even into negative territory because the money supply has been falling.
I think the Fed really wants to make sure that it has done its job, and job owning is part of it. But I do believe the equity market, certainly the way we've started the year, are beginning to see to the other side. And sure, maybe they go up another 25 basis points, maybe 50, I don't know. But I think we're just about there. And the market is a discounting mechanism after all. So if it can see to the other side, then we should be okay.
Wood contended that despite investors abandoning high-growth technology stocks during the Fed's rate hike cycle, the current moment is not comparable to the dot-com bubble. She emphasized that most of the market-driving innovations were developed after 2001 with lower costs and more advanced products. She expressed her bullishness on the sector, stating, if our prediction is accurate, the benchmarks that symbolize the conventional world order will be disintermediated and disrupted by the most significant innovation period in history. According to Wood, innovation solves problems and has historically gained share during turbulent times.
Interesting that people do link the two together. I think that the muscle memory has more to do with the tech and telecom bubble and bust and people fearing that we may be in the same situation. We are not. In fact, the seeds for everything that's happening today, all of the innovation that's happening today, they were planted in the 20 years that ended in the tech and telecom bubble. But the technologies back then were not ready. The costs were way too high. We didn't get the big breakthroughs in artificial intelligence until deep learning 2012, transformer technology 2017, and now finally we have a chat GPT. People are beginning to understand that the ground is shifting underneath us when it comes to innovation. Unlike in the late 90s, investors rushed into the late 90s, weren't ready for them. Now they're running away. They really are running for the hills. And what are the hills? They're benchmarks. That's where they think safety is. But if we're right, the benchmarks, which represent the traditional world order, are going to be disintermediated, disrupted by the most massive innovation period in history.
Wood concluded that these technological innovations are deflationary, which will cause a boom in the products and services associated with this innovation. What is your opinion on Cathie Wood's perspective? Do you agree or disagree? What are the reasons for your stance? We encourage you to share your thoughts in the comment section below. If you found this video informative, please give it a thumbs up. Don't forget to subscribe to our channel to stay informed on the latest news and videos. Thank you, and we'll see you in the next one.